Did you know that the interest rate on your mortgage, your credit card, even your car loan could be influenced by something as boring as a treasury bond? Yep, government bonds may not be sexy, but they have the power to make or break your budget. And now Trump's team is laser focused on them. Why? And how does this tie into his ongoing feud with the Federal Reserve? Let's dive in. Trump's economic advisors have been making noise about Treasury bond rates. Specifically, they want lower ones. Treasury bonds are basically IOUs from the government. Investors buy them and the government pays them back with interest. And in return, these bonds help set the baseline for borrowing costs across the economy. Right now, the 10-year Treasury yield, a major benchmark, is hovering around 4.3%. That's way up from the near zero levels we saw post-pandemic. But here's the kicker. Trump's team is frustrated because Treasury yields are staying high, making borrowing more expensive. And one big player holding the line on high rates, the Federal Reserve. Okay, so who has more control over things like mortgage rates, the Federal Reserve or Treasury bonds? The answer is both, but it depends on which kind of interest rate you are talking about. The Fed controls short-term rates. The Fed sets the federal funds rate, which influences short-term borrowing costs like credit cards, auto loans, and personal loans. When the Fed raises rates, borrowing costs go up. They've hiked rates 11 times since early 2022, pushing the Fed funds rate from 0% to over 5%. That's the highest it's been in 20 years. Treasury bonds, on the other hand, influence longer-term rates. The 10-year Treasury yield is a major benchmark for a long-term debt like a mortgage. It's determined by investors in the bond market. When demand for Treasury bonds is high, the yields go down, and so do mortgage rates. But when demand is low, bond yields rise, and so do mortgage rates. Which of these has more impact on mortgage rates? Both. The Fed's rate decisions set the stage, but the mortgage rates follow the 10-year Treasury yield more closely. Right now, the Fed is holding rates high, and bond yields are also staying elevated. This is pushing the 30-year mortgage rate above 7% compared to 2.7% in 2021. That means today, the same $400,000 home cost over $1,000 more a month in mortgage payments than it did just a few years ago. Ouch. And then there's politics. Trump has been very vocal about his frustration with the Federal Reserve. Why? Because he believes the Fed is keeping rates too high for too long, slowing down the economy and making it harder for people to borrow. He's been especially critical of Fed Chair Jerome Powell, who he originally appointed, but has since called a terrible choice. Classic. But here's the thing. Trump's team can't force the Fed to cut rates. The Fed is independent, in theory, and is keeping rates high to make sure inflation doesn't come roaring back. So instead, Trump's advisors are pivoting to Treasury bonds. If they can create policies that increase the demand for Treasury bonds, they could help lower the bond yields and bring down the mortgage rates without waiting for the Fed to act. How might they do this? They could encourage foreign investors to buy more Treasuries, or cut government borrowing to reduce the supply of new bonds, or enact market-friendly policies that boost investor confidence in U.S. debt. Lower Treasury yields could drop mortgage rates, but if the Fed doesn't play along and keeps the short-term rate high, credit cards and auto loans will stay expensive. So what should you watch for? If Treasury yields drop, expect lower mortgage rates, but inflation could return. If the Fed finally cuts rates, credit cards and auto loans will get cheaper. If neither happens, borrowing stays expensive and housing remains a tough market. Bottom line, Trump's team is eyeing Treasury bonds because they might be the fastest way to lower borrowing costs, but the Fed still holds the key to short-term rates. That's it for this week. This is Jeannie, the 401k lady.